Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice. Nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Welcome to the Retiring Real Estate Investor Podcast. I'm your host, Brandon Bruckman. I'm joined by Flint Jamison, not Brad Pitt. But it is Flint. Flint is here. We were joking off air about Flint reminds me of, if you're watching online, Flint has a Rory McIlroy kind of look to him. As I'm just
comment below if I look like Rory.
Comment if I'm on point with that, or if I've been watching too much golf and I should be doing more work. One or the other. Flint, thank you for joining us. I really appreciate it.
Yeah, this is awesome.
So we're gonna try to have the best time that we can. So Flint runs and founded Vestas Capital, and your firm, you're focused on syndication, and from what I can glean, and helping folks really get passive and get involved in the real estate game. Talk to us about how you started Vestas Capital and what your goals are.
Yeah. So Vestas Capital is me, but I partner with experienced operators. So I guess my tagline, just being blunt about it, is I help my friends and family and investors invest in a diverse portfolio. So as I say, you could, if you know a Dallas-Fort Worth operator that's been doing deals for the last 10 years in Dallas-Fort Worth, they're the operator you want to work with because they know that market through and through and they know what they're doing. But if they're the only person you know, you're only investing in Dallas-Fort Worth Class B assets, right? So what if you want to change states, change classes, do self-storage? And that's kind of where I ended up falling into this. It wasn't my plan from the get-go. And it's actually worked out pretty well. So I partner with experienced operators and bring investors along with me. And we do multifamily. We also do build-to-rent development, hopefully self-storage soon.
Awesome. What other particular markets that you're focused on? Or as you mentioned, is it more operator first?
I'm definitely an operator first, invest in the jockey over the horse. But yeah, you do need to be picky about the market too. It all comes down to the deal as well. But if there's another operator that's like, I just did a Columbus, Ohio. I didn't anticipate that, but it was a 94 unit townhome community in Columbus. It was like, Columbus is a great place. And I hadn't ever thought about going there, but I got this great opportunity to partner with incredible people. And yeah, now it's running. That was actually 2 months ago.
That's awesome. Talk to us a little bit about your backstory. You didn't plan this. I can relate. I haven't planned much. And if you'd have told me this is my journey 20 years ago, I would have said, what is that guy thinking? Like, how did you end up here? How did you end up here? How'd you kind of fall and work your way into this?
Okay, so I want to take this conversation a little bit deeper. I want to talk about mindset here because, so I'm historically an engineer. I worked in aerospace for 20 years, and when I was at Boeing, I worked 787, and I was doing these informational interviews with these high-level VPs. Just how did you get to where you got to? Just trying to understand people's paths through life, and a majority of them would say, I ended up in this position. It was largely serendipitous because as long as you're doing good work, opportunities will come, and those opportunities will come that you didn't expect. And so let it happen. Let life happen. If you're providing a huge amount of value and people really like what you do, things will happen. So flashback 2018, I burned by rehab, rent, refinance, repeat a duplex in Milwaukee. It was remote. That's another much longer story. It was successful-ish. I didn't lose money. I sold it actually at the height in 2022. Serendipitously, it worked out. But I realized out of that I was only making $300 per unit per month. And that sounds good. I mean, I'm making 600, quote unquote, passively per month seems good. But if you say, I want to make $100,000 and exit my day job, I would need to do 50 more units. That just seemed unattainable in any time frame. So I discovered syndications, the economies of scale, working with teams, working with other experts, doing bigger things. And I said, you know what, that seems to be the end path where a lot of real estate people who keep continuing down the path of growing real estate, because you could start out with single family home, you might do wholesale, you might do fix and flips, you might do like a 5-unit. And eventually a lot of us in the syndication world, we've come through some path and ended up at syndication. And it's kind of like the end of the path, because it seems to be the greatest accelerator for your money.
We're going to have to go into the Milwaukee thing in detail, because I was watching over my shoulder as I'm based here in southeastern Wisconsin. We're going to have to go into that in detail. So we're going to have to talk about that one a little bit. Let's do that in a second, though. I want to go back to, you say we want to take this on mindset a little bit. So it's very interesting, and to maybe expand upon that a little bit, of doing good work. And then the first thing that I thought of is when those opportunities come to you, I watch a lot of people hem and haw about those. Maybe just say yes to a few more of those opportunities that come your way, instead of constantly thinking through, is this the best thing for me? Should I do this? Should I do that? It seems like you maybe have said yes more than no when you found something.
So let me double down on that.
Yeah.
That is something I tell a lot of people is, if I had said yes sooner, I would be in a much different place now. And I could have said yes probably a year and a half sooner than I did. So after the duplex, I'm an engineer, and to all the engineers out there, we all have analysis paralysis. We all have natural skepticism. I think it's ingrained in us in school. When you're building aircraft, it's natural. I mean, people's lives are at stake. And so you have all this huge army of people double checking you. And in this world, you don't have a massive army of people double checking you. And if you're a passive investor, you're kind of running solo. So at some point, you just need to decide, do I know, like, and trust the operator? Do I like the market? Maybe I should just say yes. And you might find out that that was the best decision. Because the other thing on the mindset is, when's the last time the worst thing happened to you that you've ever thought of?
This isn't an airplane. No one's going to die.
Right.
That was actually, it reminds me of a story. My first job out of school was at a logistics company, and they're going through a major transformation process, and people were getting really burned out on it. And our director came in, got everybody in the room, and looked at everyone, said, "Hey, are you bleeding?" Went to the next person, "Are you bleeding? Are you bleeding?" I was like, "No." I was like, "That's fine. Like, you're okay. It'll be okay. We'll work our way through it, and it's just stuff, and we'll get there."
Yeah.
And this is similar. Like, I don't think anyone wants to have loss of capital. And I think you're focused intently on it. Our firm is focused intently on avoiding loss of capital. But if the worst does happen, what will that be for you? And I think that's an important risk mitigant to think about, is if you do invest this and that's always a risk that's out there, is loss of capital. What happens if that does happen? What does that mean for you? And if it means you're not bleeding, then maybe you're going to be okay to kind of say, yeah.
And to add to that, we as a society have normalized ourselves to investing in Wall Street without asking a whole lot of questions. And they have normalized the high risk, high reward statement, which you don't have to have that. You can have low risk, high reward. Mm-hmm. But in Wall Street, to me, high risk, high reward is you take the risk, we take the reward. Mm-hmm. Wall Street takes the reward, right? It's just it. And that's where I jumped into real estate, because I was like, I can't handle the stock market anymore, mostly because if Elon sneezes, the stock market moves. It's like there's nothing stable managing and keeping it where it's at. For tangible assets tend to be way more stable historically. You can actually look this up. The data doesn't lie. It's just invest in the basic human need of shelter, and it can be lower risk, higher reward.
And it's a different sort of mindset. I mean, how we could spend another hour talking about this, but the limitation of the amount of expertise that we see from generally the investor space is just limited, where through our background, your background, and what we've come to sort of learn is this investing space is so infinite. There are corners of the universe here that I've probably never seen, and I've seen some weird spaces, to say the least. Right? I've watched hedge funds invest in movies. I've watched just the weirdest things you could find. Right? And still, I'm probably limited in my knowledge. Now I look at most folks, and yes, they're limited to their 401k, or limited to what's been placed in front of them. And very often it's definitely not real estate. It's certainly not real estate passively. Is that it? Is that the biggest thing for folks? Is just an education awareness gap on what's...
I think so. And to be honest, if you follow what society thinks, I firmly believe it's driven by the big financial institutions that have billions of dollars to spend on marketing and shape the way we think, because they're the ones that are making the money off of us. Whether we are gaining or losing our money, they're still making money on us. So here's a resource for all your readers. There's a guy named Garrett Gunderson at the Wealth Factory. He wrote a book called Killing Sacred Cows. If you want to start opening up your mind to the world of other things beyond Wall Street, maybe a good place to start is Killing Sacred Cows. And then you can get into, he's written a bunch of other books, but start thinking like, how do the millionaires and billionaires invest their money, and start modeling how you should invest your money. Because you don't have to be a millionaire or billionaire to do it. Because yes, millionaires and billionaires invest in real estate, and you can too with $50,000 with Brandon or I.
Yeah, we'll have to put that one in the show notes. I thought you were going to reach over your shoulder and grab it. That would have been, I don't know.
No,
it's around there somewhere.
No, my dog's stuck in the door. I was like, what's going on behind me?
I thought it was there on the shelf for folks who are gonna highlight it. No, that's a good.
I
don't know that one. I haven't read that one, so let's put that on my list as well. It's just a matter of opening up your mind a little bit, and then there's access. And our billionaire friends all started somewhere. And it's a matter of how to get there. This is good. Talk to me about, let's kind of hop back to the fund a little bit. Talk to me about that selection of these great partners. Like, what are you looking for? Track record's got to be paramount. What other markers and indicators are you looking
at? I think investing philosophy comes down to it. Like, what's your plan and purpose for doing this property? Have they done back to? Are they jumping into a brand new asset class? Do they think that they can handle the new asset class if they're classically done 6 Class Bs and now they're going to try to do a heavy lift Class C? Right? There's all sorts of things. I do have a list, but to be honest, a lot of this is down to character and references. Our world is, even though there's probably 1,000 of us syndicators or more, our world is fairly small, and I know someone that knows them. And I definitely do reference and character checks, because a lot of things can come out of the woodworks.
It's sort of interesting. And you've seen probably over the last, what would you say, maybe 3 to 4 or 5 years, you've seen a lot of new syndicators enter the space. Yes. Is that a red flag for you, or is it more of a look of, well, how or why are you here in this space?
Oh, that's an interesting question. A lot of the operators I've partnered with have a track record longer than those years, or if they did start 5 years ago, they've done a lot, and those assets, like right now, with the economy going through all the speed bumps it's going through and the interest rates being super high, it's shaking out things. And the last operator I partnered with, out of all the assets they still have and that they've bought, they're still running super healthy. So they made really solid decisions even before the economy went down, and their properties are doing really well. So to me, that's like, you guys know what's going on, and you're a healthy team.
Are you watching? We're seeing this on our end. It seems like, and it's a very generalistic statement, so blow some holes in it. It seems like the better sponsor you are over the last, let's say, 12 to 18 months, you've really slowed down in new deal flow to the point where there may be nothing that you brought to market at all in the last 12 to 18 months.
Yes.
Is that a fair thing for me to say? Is that a really good indicator? Like, the environment's changed dramatically, and it seems like the reaction from some of the better sponsors is to wait and sit on the sidelines.
Yeah, it's interesting because you get the Warren Buffett attitude of be fearful when others are greedy and be greedy when others are fearful. So I think it's smart, because if you look back at 2008, those who were greedy when others were fearful came out really well. But to the flip side of things, the deals are much harder to come by. Yes, there's a lot of newer players. There's a lot more competition. The interest rates are making the deals not work out as well because sellers are not lowering their price accordingly. So it's just natural that the market isn't flooded as much as it used to be. And I think that's why deals are slower. I think a lot of the operators are looking for loan assumptions. I'm seeing more loan assumptions now than I have before, which is an incredible business play. And then you can still, even now, you can still get a good deal. That the one I just told you in Columbus that we closed on, it wasn't a distressed asset, so we could get a fixed loan. So we got a 10-year fixed loan at 5.6%. And if it penciled, and it penciled really well. And it's still a value add. It's a Class A value add property that penciled. And you're like, well, there's no reason. Now we have a fixed loan for 10 years. We could have options for 10 years to do whatever. We could sell in 3 or sell in 10. So I think it's still good to keep looking. And me being a partner with a bunch of operators, I personally have more deals than that I can raise for, because on the flip side, investors are also being told to sit on their money because right now is scary times. So a lot of investors aren't willing to invest, which is actually making it hard to close on deals.
Interesting. You think those, on their mindset for a moment, do you think they're looking at, say, CDs and maybe the 10-year treasury and going, well, risk-free rates here, cap rates here, and the spread between those aren't wide enough for me? Do you think they're looking at it that way, or is it just purely fear-based?
I think it's purely fear-based, because I mean, at that point with the CDs and bonds, you may or may not be breaking even with inflation. And then if you're not even in those and you're just sitting on your money out of fear, you're just flat out losing a lot of money. So, and this is what I keep telling people, no matter what the economy in the market, there is a strategy to be played. You just have to open your mind to find new strategies. And it might not be a deal in Houston, Texas right now, just randomly making things up. You might need to find a different market, or choose to invest in an ATM fund, because that's a thing. You can invest in, this is crazy, I just learned about this, fine art. The wealthy buy fine art, not because they like to decorate their house with fine art, but because it's an incredible tax play. Now, I don't know anything beyond that, but it kind of blew my mind. I was like, oh, so that's why they do it.
And our sort of, you make a great point here, is that for investors, there's constantly a cost to be had, or an opportunity cost, or there's a dollar in your hand and something's going to happen to it. It's either going to erode or it's going to appreciate, one or the other. There's no sitting, even though it feels that way. There really is no sitting with that dollar. So you have to make a fundamental decision of what to do with it. How much do you know about the ATM fund? Can we talk about that? I don't know anything about that either.
Yeah. So I don't do this ATM fund. But there's a big operator. So a lot of ATMs are owned by mom and pops. It's kind of like vending machines. But there is a massive nationwide ATM operator. It's just systemized the whole thing. So economies of scale. And they've opened up a fund because they need investors to go do more machines. Something like 5% of the population uses ATM machines, and 5% of a big population is a big number. Anyway, so I think the metrics were like, if you invest $100,000 after a grace period of 6 months, you will start getting $2,000 worth of cash flow every month for the next 7 years. Wow. Now, put this in perspective. That's a great cash flow play, but in 7 years, the multiple is only 1.7. So if you compare that to what we do in value add, where we try to double your money in 5 years, you can do an ATM fund and get 1.7x in 7 years. So you're not doing a wealth growth strategy, you're really doing a cash flow strategy. So it all depends on the investor goals. But I could see myself, if I'm like 70 years old and ATM fund is still around, that'd be a great play.
Yeah, I see pieces of portfolios, right? Where the cash play probably makes sense. Again, for on a per investor basis and what they need. And then maybe it makes sense to deploy some of that capital to value add strategies as well. They're different sort of return patterns. I think it's funny because I think about, I don't have cash in my wallet currently, nor do I have cash very often. However, being in Wisconsin, you go north of Green Bay in the state of Wisconsin, that is a cash-based economy, and you better have some cash. ATMs are
really
there. Oh, 100%.
That's crazy.
And I've got to think other states are like that as well in some more of the rural areas.
And it's a demographic thing too.
Yes, big time. Yeah, my parents are more likely to have cash than I am. Very much more likely to have cash in their pocket than I am. So there's still a play to be there. See, it's just as we talked about before. Here's another thing that I had sort of heard about the ATM side, but haven't explored it. So there's all these great example, like another avenue that is out there for folks that I don't even know about. So there's all these kind of avenues to sort of roll.
Oil and gas is becoming a thing. There's a lot of real estate syndicators now moving into oil and gas. Mm-hmm. That one I haven't wrapped my head around yet, but apparently, I mean, that's a promise of really massive returns, but I do think that there's also a higher level of risk there.
We'll talk about that one offline. We've done some homework there.
Yeah. Because I haven't done anything
there. I've done some. I've gone to the fields. I've spent.
Okay.
Yeah, I think we spent some time there to try to unpack that a little bit. Fascinating.
Okay.
Fascinating sort of space. It's interesting. It still has a very mom and pop type feel to it. It's becoming institutionalized a bit, which is sort of interesting. Which, from our perspective, I think is helpful for investors. I think it's tough not having that. And this is a big thing, and I'd love for you to talk about this when you talk about the sponsors that you partner with. That investor experience is, the investment is obviously more important that's performing, but a close number two is how those investors feel when they're in that investment, their type of communications they're getting, and the timeliness of the tax docs, and all these things around customer service, that sort of institutional quality, bringing it to that, is what our investors have come to expect. Is that a checkbox for you when you're looking at sponsors? Like, how do you interact with investors?
Yeah.
Post-close?
Yeah. I really like, well, for one, transparency. And I mean, right out of the gate, when you're doing a value add, you want monthly updates until the updates become so repetitive or boring that then you go to quarterly. But no matter what, quarterly, you typically also give your investors a finance packet too, to show here's how our property is performing and here's all the money we spent. This is something way beyond what you get in other investments like Wall Street. You don't get to see all these. Well, I guess you can. They give out a quarterly or yearly booklet that's super thick. But anyway, we communicate a lot, and we're here on the phone. Our investors can call me whenever they want, or text me, email me. So it's a personal relationship.
You're not calling. I challenge you to call a large mutual fund manager. Ask them what is speaking today. Like, it's just not going to get that kind of access. We just noticed a huge variation between some sponsors and their communication patterns and others, and their timeliness compared to others there's a big gap there. I think there's an opportunity for improvement. We see it across the industry a little bit, which is good. We all got to get to that institutional quality kind of communication. Like, it's a must. So it's
Yeah,
happening. It's totally.
you're right. And some do some things well and other things worse than others. And you just got to learn from the crowd to see what you like the most. But yeah, you're right. Some of them don't have all the systems in place. Sometimes if you have a big accounting firm helping you out, or you have in-house accounting, sometimes you can get some really good reports. But yeah, if you're a smaller team, some of those are harder to create.
Is that important to you too, as you look at some of the sponsors, is team size and thinking about if they're building sort of a team there, or they maybe personally, we like folks that can hand us a fresh org chart, like they're just starting to build into that team and building processes around it. Are you guys similar in the way you sort of start to look at it?
Not necessarily. I've partnered with some smaller teams. I mean, they've grown big, and then they decided they grew too big, and they were spending money they didn't need to spend, and so then they narrowed it back down, and now they're down to I don't know, 4 people, but they are super powerful operators, like to the point now where they're doing a big development fund with 5 properties, $50 million, and they're just really, really savvy and efficient. So yeah, it all depends.
All depends, right? If you can do it with 4, do it with 4. Don't do what you can do with 4 with 20. That would be slightly inefficient. Just sort of do it that way. That's interesting. You mentioned before that you're looking at storage a little bit.
Yeah.
Can you talk about that maybe broadly, of what attracted you to maybe that space and start to peek at it?
So yeah, and to be honest, I haven't actually seen a storage deal come through lately, just to look at the numbers. But if we go into a couple of years past, if you compare storage to multifamily, they were a little bit inverse of each other. So self-storage would have a bit higher cash flow, but a lower return on the upside when you sell. But in the end, you kind of get the net same result. But it also allows you to diversify into an asset class that for some reason, all Americans for some reason need self-storage. I mean, self-storage has been recession resistant, COVID resistant. It is just like, it's a super stable asset class that it kind of blows my mind, because it's not a basic human need, but Americans have proven to ourselves that we have to have self-storage. And I think it's just a great investment opportunity.
It is fascinating. Some of the and our investors have heard me tell this story before, like some of the base cases we saw. We were very concerned during COVID, obviously, as we were checking in on a lot of the investments. And for some reason, we're watching storage occupancy spike. I'm like,
yeah,
why is that? And so we made some calls. Why is it happening? And this storage unit in particular is relatively close to a college campus. And so what the kids were doing was they were moving out, going back home, but they were putting their stuff in a storage unit.
yeah.
Oh my God.
And that was, that was the same across the US. It wasn't even college students. It was a whole bunch of people just in apartments, houses.
They're stacking up on paper towels at Costco, and they're shoving them in a storage unit. It's just always seems like it's something with storage.
Yeah.
Makes that popular or interesting.
And then
sorry, go ahead.
Well, I was going to say, with the COVID, the number of RVs that were purchased or now need to be stored. So boat and RV storage along with the self-storage, it's just, yeah, it's a great opportunity. And it's low cost. I mean, you technically don't have tenants. So technically, because you will always have someone that decides to live in a storage unit that you have to evict. But
we thought it was intriguing from an inflation play perspective too. Your ability to move rents on almost a monthly basis in that asset class is very intriguing. Obviously, it takes some work there, right, to make sure you're saying those prices right every time. But the flexibility there is very intriguing.
Or you're saying it's a variable rate lease, or is it?
Yeah, month to month. Yeah, month to month is what we see a lot.
Oh, interesting.
And some of the storage stuff, so they can make those adjustments on pricing. So we think that's intriguing as you consider to see some of this inflation's not dead yet. It's still, it's not going anywhere is what is kind of our viewpoint, that we're still going to have, people aren't going to go back to working at $12 an hour. They're at 20. So where's the inflation going to go per se? So it's going to be there. So having a little more flexibility there is intriguing to us in that asset class. Are you guys looking at is there a space in the storage that sort of makes sense? Is it new development? Is it a certain class, or maybe haven't gotten that far?
This is where no, I haven't gotten that far yet, and it really comes down to the operator that we mutually decide to partner with and what they do. Based on the one that I am talking with, I think it's just value add, buying these properties up from mom and pop, and then automating it.
Big opportunity still as we're watching folks continue to do this. Any other asset classes on the radar? Multifamily.
Yes.
Storage.
I really like triple net. So if I do triple net lease, it would likely be industrial. I don't know. Retail it makes me itchy. I don't feel strongly about retail. But industrial, there's so much industrial popping up, even here in Denver, and the prices of Denver are skyrocketing, but there's still industrial going up everywhere. And you get these triple net leases. I just think it's a really great play for an owner.
We continue to bang, couldn't agree more. We continue to bang the table for we will make everything in America again. And it's really, it's exciting if you want to kind of get around this sort of reshoring movement that has happened. It's fascinating. We see the same thing on the ground here in Wisconsin. Occupancy rates on manufacturing buildings are over 99%. Like you couldn't find a building here if you wanted to build something. So it's the dynamics of it are fascinating, and then the cost to build is really expensive.
Yeah, and what's crazy is there's all these unique business strategies you can do, because you might find, I'll use a doctor's office, but this works in industrial too. But you got, say, a dentist that wants to expand his practice, and he owns the building and he leases out a few other offices to other dentists. All that infrastructure is there. So he chooses to sell the property, put a 10-year triple net lease in place. He gets cash flow for himself so he can go build more dentist office and expand his business. And you end up with this property that you're triple net leasing to multiple dentists, and you're just like, and you can do the same thing with industrial. Some of these guys want to expand and they need to sell the property, and you take over the triple net lease. It's such a great value play.
There's so many different avenues to go down. Where do we find the time? How do you think about that and prioritizing which of these opportunities you're working on? Are you still in more of the, I don't want to say acquire some of these relationships or build these relationships with sponsors? Do you feel like you're more in that mode to find more of these folks?
Yeah, I have several in my back pocket with the self-storage, with possibly industrial. But it also comes down to what I think I can bring to the table, to the team. And if I don't have investors, if all my investors are sitting on their cash, then I can't raise very much money. Like I did a recent raise, and it's hard. Even if you're a big operator and been around forever, like Joe Fairless, he's struggling to raise money. I'm struggling to raise money. And that's the thing that's really holding me back, because I hate to commit myself and not come through.
It's a hard thing, right? Because you just don't know. There's no, how do you know for sure if you're going to be able to raise what you can raise? It's a very difficult task. You're just never quite sure how investors are going to react to that.
It's crazy because I do polls. I put out a poll to all my investors. Hey, I've got this, and I'm kind of vague. There's this asset class. I put a pretty picture, and here's the general returns. Are you looking to move money? Does this interest you? And then I say how much you're willing to invest. It's kind of like a pseudo soft commit. And I got like close to $1 million on a soft commit. And then when it came to the actual raise, a majority of those never committed. And I actually found new investors to get myself to $500,000. And it was like, I didn't commit $1 million though, because I was smarter than that. I know how this works. Yeah.
Hedge. It's fascinating. It is not, it's not an easy time for any of us, frankly.
No.
The playing board has been shifted by our buddy Paul. He's a longtime listener, so if there's anything you'd like to say to Jerome, go ahead. I'm kidding. I don't know. It's tough. It's a tough spot to be in. And I understand what they're trying to do at the Fed, it's inflation back, but it's not making our lives any easier.
No.
No.
And here's the crazy thing. So I just learned this at MF and Con. I think it was Omar Khan that mentioned this, that when interest rates start dropping, because they're going to come back down, we all know that. And when they start coming back down, apparently there's an inverse effect in Wall Street where the stock market will also, it's not inverse, anyway, you think with the interest rates going down, you would have your Wall Street would go up, but apparently your Wall Street goes down with the interest rates. Yeah. You go fact check that. Don't take my word for it. I'm not a CPA or financial advisor. Disclaimer. This is just what I heard.
Oh, we disclaimer the heck out of this more than you can imagine. It's one of my favorite things to do is read disclaimers. Yeah, it's fascinating to watch. We're talking in July, and watching equities rally like crazy for the majority of this year. We're watching indexes rally, and everyone's looking at each other like overbought, it's going to crash, et cetera, et cetera. And then we come to find out no one knows anything about where anything is going in the future. So no one has any idea. So it'll be intriguing to watch sort of what happens. But investors need to be got to have your head on the swivel a little bit. But I think you're right. And we got to go back to what we had discussed previously in looking at some of the principles here. It's more about this sort of longer term strategy and thinking about, okay, if I'm in 1-2 asset classes, there's another 6 or 7 out there, probably a pretty good fit for you, and probably don't react the same way as numbers 1 and 2. That's how millionaires, billionaires, and if you look at, we love to look at places like Harvard Endowment Fund, Yale Endowment Fund. Oh, look at the diversification across that book. It's pretty wild, and how much they've changed over time as well. That's a good model to take. People are very risk adverse. All of what's going on there, they've got billions of dollars. They know what they're doing with it.
Actually, I found out the other day from a guy that considers himself the anti-financial advisor, but he said that the S&P 500 is no longer this massive diversified thing. It's so heavily weighted on tech stocks, so it's not really a good indicator anymore.
No, I think that's a very fair statement to say as well. Plus, if you've watched this rally over this course of this year, really starting in December, very concentrated on top of that. So not only do you have an index that's concentrated, you have a rally that's very concentrated as well. So there isn't the kind of diversity there that you would expect. And the point we always kind of pound home with clients too is, if you have, we'll look inside a lot of 401ks, we'll see a lot of the same stuff repeated 7 times. We're like, you know what's going to happen when the market goes down? All this is going down.
They all go down. Yeah,
they all go down at the same time, right? This isn't really diversified. So that's this magical sort of unicorn in the sky of diversification. That's sort of hard to define. There's a book definition, but to achieve, we rarely actually see true textbook diversification across people's portfolios. If we can help them get closer to something like that would be great. But we just don't see it very often.
Yeah. You got to change asset classes totally. Yeah, that's how you diversify, is get into completely different asset classes, because Wall Street is one asset class.
They have to, the textbook definitions, these things have to behave differently at different times. They just have to. And if they don't do that, then they're correlated somehow.
Yep.
So that's not what we're not getting to diversified yet. That's a magic place we're going to go to. It's a magical land with some things that exist somewhere that we can hopefully achieve. This has been Flint. This has been fun. I think we've taken this to the full conversation level as promised. What aren't we sharing? What else do you want to share with our listeners?
We didn't talk about built to rent, so that's another asset class that I'm actively doing right now. Yes, just a brief overview. Built to rent is we essentially build a housing community of starter home sized houses, but the intent is we manage it like it's a commercial multifamily property. So we have on-site property management, maintenance. All of the tenants are renters, but rather than being in an apartment, they have their own little house with a front lawn, back lawn, and then amenities galore as well. So It's one of the newest, hottest asset classes out there from a development standpoint. Lots of big institutions are shoveling hundreds of billions of dollars to invest, and they don't build. So here we are, we're building. It's every town in the U.S. is going to start seeing these built to rents pop up if you haven't already.
I have questions. Do you think every town and every market has an opportunity for this? I tend to think, here's my thesis, and blow holes in my thesis. So I think that this is a great point if there's a huge differentiation in a market between what I can rent for and what I can buy a home for. If there's a gap in there and enough sort of buyers in that space with the proper income level, this is the option. If I need, I want a yard. I just had a family. I got to get out of this apartment, but I can't buy the house that I want. Built for rent.
100%.
Is that right?
Yes, 100%. So that's one of the major factors is the huge disparity between cost to purchase a house versus rent a house. The other thing is in 2008 and beyond, the home developers stopped building these starter home sized homes because there was no margin in them. So they're like, what are we doing? Let's go build the 2,500 square foot plus homes because they make margin. So the supply for starter homes just totally diminished. There's a chart out there. You can just see it, tank on supply of starter homes. So this is a great compromise to allow builders to come in. They build an entire community and sell it as a commercial property. So there's margin there. And now you're providing supply for starter homes, which are much needed. And then also the great compromise is millennials now are starting families. It's the peak family building generation right now, and they want to get out of apartments. They can't afford a house. So here's the best compromise. Oddly enough, there's another demographic that's really hitting BTRs is the empty nesters. Because you're 70 years old, you're tired of taking care of your house and you want to move closer to your grandkids and you want the lock and leave culture. You want to be able to just close your house and go travel Europe for 3 months. And there's the younger generation and older generation love that lock and leave. So you can do that when you're in these rental communities.
I like that. I haven't heard that before. Lock and leave. That sounds good when I kick my kids out of my house. Like, I'm out of here, man. Lock and leave. I'm gone. It is a vast point. Is I've actually and I like to look at things micro and see if there's a macro application. But I see it in my neighborhood. I see older folks who built here and have been here and stayed here.
Yeah.
They need someplace to go. I wasn't thinking about that demographic though on surface. I was thinking about built for rent. So it's good that there's multiple sort of base cases for potential tenants there.
Yeah.
Not just that one. So then maybe there is more application across additional markets than I initially thought. Initially, my thought there is it was more narrow, but you've kind of widened out the renter base.
Yeah, it seems to be, really where there's a housing demand, built to rent helps because there's a massive shortage of housing units across the US, like to the tune of 3.5 million was the latest statistic I saw. Jeez. So when you have a massive shortage, economy 101, supply versus demand, and that drives prices, which is why housing is so high because there's just not enough supply. And you've got the biggest generation looking to buy right now, the millennials coming in, creating families. So yeah, there's huge demand and prices. Yeah, we might slump a little. Housing prices have slumped a little. But as soon as the interest rates come down, those prices are going to skyrocket again. So a lot of people fear the renter nation is coming like Europe. Europe is a renter nation. And I can't argue that might be the way we're going. It's unless we can create enough supply. But it's something like in order to keep up with the demand, we have to build 2 million units every year for the next 10 years or something stupid. So
that presents the same problems though, because we're probably talking about a lot of starter units, correct? Which folks didn't want to build because there wasn't margin there. So is there going to be margin there? And if there's margin there, then they're probably going to be too expensive for folks to get into. So we're back to the same issue though of is actually going to fill that gap.
It's a vicious cycle.
But hey, out of problems comes opportunity, right? Yeah. That is, you said, is economics 101, right? There's a demand for this, and here comes a different sort of supply to fill that gap.
Yeah.
It's fascinating. It's interesting. Is it bad if we become a renter nation? Now I'm thinking out loud.
I don't know. So I love the argument of it's smarter to rent. So the example is if you have $100,000 to put down to get 20% to buy versus renting and investing that $100,000, what's the best value play? And I wrote a blog on this. I don't remember the numbers because it was over a year ago, but if you have $200,000 to invest and then I break down all the numbers and it's like, why do I own a home? I should heed my own.
How did it shake out? We'll have to link that too. I want to link that to the show notes too.
Yeah,
how'd that shake out? What was the outcome?
It shook out that you end up, based on the assumptions of returns, you'll be more wealthy after, I think it was the 10 years than you would if you bought the home. Your net worth will be higher.
Fascinating. Yeah, we're kind of pounding away on and I own a home, so that's in context
Me too.
I don't it's an asset because it has value, but it's not a great investment. But it is an awesome investment for my marriage and my family. I'll tell you that for sure.
So yeah,
high level return.
There is,
guarantee it.
And based on the definition of assets and liabilities, your house is 100% a liability, unless you put the soft subjective terms to it, like it's an asset because I have a family and I have kids. But financially speaking, it is 100% a liability. It just costs you money. It's an expense, 100% through and through. Yes, it can appreciate, but it's not an asset that pays you money, because assets pay you money and your house doesn't.
Ooh, it definitely does not pay me money. I can guarantee that. That's not happening. In fact, it's the other way around. Yeah, that's always the argument that we make is that folks only look at purchase price and what they may or potentially sold it for. You skipped all the fun stuff in the middle about lawn care and broken things and painting things and renovating things. You skipped all that. Didn't include that in your analysis. You've conveniently forgot. I have not forgotten. I know how much the floors are that my wife wants done. And I will not what this number is. It's not helping at all. It's not helping at all. So yeah, it makes sense. I mean, it's something that we encourage our kids to do, is to kind of tighten up your financial life first. And make sure you're investing first, and then start to think about, okay, does the home fit sort of my lifestyle? Is that what I want for my life? Okay, fine. Like I can live with that. That's fine. Right. But
however,
God, don't think of this as your biggest and best asset. That is may not work out.
There is a unique play you can do. So for younger people out there, or the singles in the world, the best way to get into real estate, house hack. Turn your liability into an asset so it starts making money. Start renting out a room, rent out a basement. That is by far the easiest and best way to get into real estate. You live there for a year, you move on, you buy a new one, you house hack that. Your old one and then you just snowball. Your old one, you keep them all, and then all of a sudden you have a real estate empire.
It's something that I've watched some of our sharper clients do with their children. It's something that I encourage for my children who are definitely less likely to listen to the podcast than Jerome Powell. We'll send them a cut up. Please go and buy a duplex and lease out the other side and turn that into an asset.
Or a condo and rent out a room. I mean, it doesn't have to be fancy. Just get a roommate to pay something. Yeah.
Do something. Well, this has been great. Flint, I'm taking you way over time. Where can listeners find you? Where can they learn more about you and all the great stuff?
So my business is called Vestas Capital, but you can find me at investwithflint.com. It's much easier to remember. And then if you want to jam with me, I'm on LinkedIn, /Flint Jamison. You
can find so many fun people on LinkedIn. It's kind of the way that Flint and I met. So definitely head out there and check us out there. Flint, thank you so much again. Appreciate you hopping on.
Yeah, thank you. This has been fun.
All right. Thank you everyone for listening. Until next time.